I'm Whitney Tilson. I hope you enjoy this video. If you'd like to learn more about Kase Learning and our programs, just go to caselearning.com. And if you have any questions, just email me at info@caselearning.com.
Let's see, following Ben Axler, what a nice thing. Great research there, Ben. So when I first presented an idea at Whitney's last forum, I think in May, he came up after I presented it and he put on the screen, he goes, "That is a cheap stock," right? You recall that? He said, "That's a cheap stock." And that was 30% ago. So what we do at Cruiser is we try to differentiate between value plays and value traps. And what we're about to show you, we think is the epitome of a value trap. One of the things that really resonated with me today is how a lot of people have said follow the money and watch where the insiders are selling. You'll see that in this story here, which we think is a company that with a very talented management team that's been dealt a dead man's hand. And to get on my soapbox here, because I have an opportunity to do so, you know, I think that Dodd-Frank, for all of us, created a lot of negative unintended consequences. And one of those was at the same time that passive investing sort of overtook the investing community, is it deprived minority shareholders of a real voice in the boardroom. And I think what you see across the landscape of all the companies that we look at is that insiders and directors own very little stock, have very rarely actually bought any stock. And at the end of the day, they're more net sellers. I think it's a problem. I think that Dodd-Frank created a paradigm where directors can be excused from being concerned about the capital markets. And hopefully we can all address that. All right, so dead man's hand. Oh, when you deal with Cruiser, by the way, you don't get one disclaimer, you get three, okay? We are, as Whitney mentioned, we are running a proxy campaign on Ashland Global ASH, and because of that, we need to put some extra stuff in there. We are a long-short fund. We're primarily long. We're very concentrated. Rarely do we have more than 10 longs or 10 shorts. We'd like to spend a lot of time with management teams and thinking about what motivates management teams. The last 9 years, I think, has been an incredible opportunity to objectively evaluate managers, right? Capital has been available to everyone. All you needed was a good idea and you could raise money. And the question is, how did it work out? And we're all capable now of really putting together the pieces to see which managers did well and which didn't. And I think that objective scorecard is really important. Really interesting to see how in the last one, last presentation, you know, the compensation committee gave max comp to an underperforming management team. We look at that stuff a lot. As I said, value plays versus value traps, that's sort of our motto. Cash and patience are our allies. And then very importantly, we try to look at the exit strategy, right? Who's going to buy the company from us, particularly on the short side, right? If we're going to get heavy on the short, and this next one we're pretty heavy in, you know, we want to just make sure there isn't a buyer, right? Waking up in the morning and seeing that someone bought you out would be a disaster. We spend a lot of time mapping out the corporate structures on both the long and the short side. Okay, where are we? All right, how does this thing work? Okay, there we go, dead man's hand. Okay, that happens to be Bill Hickok's dead man's hand. Aces over eights. He was shot when he had that hand. Okay, Michael's Stores. This is the world's largest framer. They are the number one arts and crafts specialty retailer in the country. They have lots and lots of stores that sell stuff that probably no one in this room uses, but we know people, mostly little people, who do. They had a business called Aaron Brothers, which was a framing business, which they recently closed and they brought inside. Why is MIK attractive? This is from their website. They are the number one destination for making. That is not bathroom humor. That is actually on their website. They say they have a strong financial position. We think that the ROIC that they present is actually not exactly correct. But we'll show you how we get there. They're the number one player in a slow growth, fragmented industry. There's an opportunity to win greater market share in a slowing growth business. We're not so sure why that's an exciting thing. Financially disciplined. We'll evaluate and you can decide who they're financially disciplined for. Okay, here is the business. You get to see these wonderful things. There's Gronk, Check out Gronk. Everybody loves Gronk. Everything that Gronk is wearing, the little lei, the little thing in front of him that's got, Gronk juice in it and the straws, surprisingly, you can buy all of that online. I don't know if you were aware, but you can. You don't actually need to go into a store when you throw your luau party. You can actually buy it there. And then in the lower right-hand corner, this is really important. These guys right here, they're very handsome and famous. They're pointing at the frames. Again, they're the largest framer in the world. So people come into the stores supposedly to get their frames. Well, and there's the CEO and the head of NASDAQ there with a frame around them just to emphasize it. So they love frames, okay? Everything's framed. So on August 30th, I think I spoke to Whitney's class about 2 weeks prior to this. So on August 30th, they announced, as we've discussed for a few quarters now, all of our data continues to suggest that the growth trends in core arts and crafts remain soft. But despite the environment, we've delivered operating income and EPS growth that were even better than the guidance we provided in June. Stock was down 20% on this, okay? So even though EPS can grow, the fact is the rest of the metrics aren't that exciting and people kind of get the joke. Okay, framing, let's just talk about it because it's really important. It's 15% approximately, a little more of their revenue, but it's about 33% of their income. This is really important. Because when you go into that store where Gronk is selling all that tchotchke stuff, okay, there isn't a lot of margin in it, but this is a great margin business, okay? Why is it a great margin business? You bring in something to get framed. It's highly customizable. You sit with someone behind a desk. They tell you how important it is. You frame stuff. You build it up. And it's really great. There's lots of upsell opportunities and lots of margins. The problem is that online presents a tremendous challenge. This was Lee's Art Store literally around the corner from here. It was a 100-year-old business in New York City. It closed 2 years ago. They just couldn't withstand the competition. They called out Amazon specifically when they closed. Pearl Paint had 28 stores in this area. Same thing. They were an artist place. Also lots of pressure. When you go online, Aaron Brothers is Michael's. It is their framing business now within all of them. It's kind of easy to find frames. Now, Michael's will tell you, well, we're different because we customize everything. That's important because when you go custom online framing, there's no Michael's on there. They're not paying for that SEO on custom online framing. They are for custom framing, so that's good. That's Aaron Brothers, 3 down. That's their SEO. So if you get the joke, there's now a lot of competition, so your prices are getting compressed, but now you have to pay for your customer. Before you didn't. Right? You attracted them to, now you're paying for it. So your margin is compressing on your highest contributor to EBITDA and free cash flow. This is a little company called FrameBridge that in June, I think, the end of June, they announced a $50 million round, a Series C round from T. Rowe. Their B round was from NEA. These are really high-quality investors, folks. The chairwoman is also one of the founders of, is the chairman of Rent the Runway, the former co-founder of Crate and Barrel. There are some really sophisticated people there. And if you go to the FrameBridge website, your ability to actually frame something is really easy, and it's designed for you, like you would expect it to be done. When you go to the Aaron Brothers website, they have something called Phobos, which you can't, or Bopus, pardon me. You can't make that up. Bring it into the store. That's what it's designed to do. They want you to come into the store. We don't want to go into that store because Gronk is rarely there. But anyway, so we don't really want to go in the store. We'd rather send it in and make it all technological. This is their problem, right? There are lots of people offering less expensive online versions of framing. Okay. The company talks about their total debt to adjusted EBITDA. As we all know, next year, these numbers are going to look a little skewed because we're going to have to capitalize leases. We'll get to that in a second. They capitalize leases at 5x. I think that's a bit of a challenge. It's usually the rule of 8. But look at the adjusted ROIC. It's 27%. That's exciting, right? So to me, if you say to me, I've got an adjusted ROC of 27%. That means I invest $10 million and I get $2.7 million back for financing costs. That's what I would think that means. Okay, And that's how you get there. So it's not wrong. They're not lying. They're not being intentionally misleading. Let's just be very clear about that. But there's another way to look at it, right? Because, just notice here, they have all this negative common equity, okay? Because they were owned by private equity first. And they put that actually at the time, $3 billion of debt on the business. They cashed out. That was very nice of them and for them. And now they've got this negative equity. So the way the math works, when you put EBITDA on top of negative equity, your ROC looks higher. However, it's actually a lot lower. And if you capitalize your leases by the rule of 8, which most retail analysts will tell you you're going to do, is David Berman around here? I don't know. But when you there you are, rule of 8, as opposed to maybe 5 years when everything's got a 5-year extension. That's not bad. Don't get me wrong, but it's not 27%. Okay, it's 13. Okay. They've got negative operating leverage. This is obviously really important, assuming things are stagnant, which of course they never are. But if you drop your gross GM by 1%, overall GM by 1%, it's a 9% in EBIT. So where's all the cash gone? It's really simple. It's gone to buy back stock. In fact, when I did that, when I showed you what happened in the August press release, they also announced that they had done a $250 million ASR, which is really great, at $23, I think, a share. Stock's at 17 now, so very good use of capital 3 months ago. Here we go. This is their history of public market offerings. Oh, okay. So they've had 7. One was an IPO at 17. That's exactly where the stock is today. Okay. They raised $446 million. Subsequent to that, at substantially higher prices, they've sold approximately $2.1 billion to the marketplace, all for insiders. All for insiders. Bain, we'll get to them, $25.81. Let's round it up and call it 26 for fun. Blackstone, $1.4 billion, $23.60. That's really exciting. $1.4 billion at $23.60. And just to help matters out, the company itself bought in $300 million at $22.64. You're not going to find many directors buying any stock. In fact, you won't find any. Okay. This is up here really for Whitney. Sorry. You know who that is? Yeah, that's Mitt Romney, with the letter. Everyone knows Whitney is a big Republican supporter. So currently, Bain holds 31% of the stock. Blackstone holds 11% of the stock. The question is, who's running the company? The chairman works for Bain. He's actually a big Democratic supporter, so he puts a lot of money in Democratic coffers. The Blackstone representative now is also the chairman of a company called VSLR. And if you run a long-only fund, you're really ticked, because on Friday, the last day of the month, that little stock, which they own the majority of, had gone from $5.30 at the beginning of the month to $7, so it made your month. But then on Friday, the last day of the month, they priced a little secondary to sell their own stock at $5.50, and it broke price. So there is a little bit of a pattern here. The smart guys are selling. Okay, just one second. So where can the company improve margins? Maybe on wages. I'm running out of time. Sorry, I got a lot of slides here. Here's the stock price performance. Here's the short interest rate. It typically goes up into earnings, and typically throughout the last year and a half, everyone's gotten paid. The metrics, okay, this will, as you see, so is this a cheap stock? That's the question, right? EV to EBITDA of 7.4 times. EV to EBITDA of 7.5. That's capitalizing leases. Not capitalizing the leases, we're at 7 times, okay? Party City is at 7.7, so you're right in that. But what if you're really Bed Bath & Beyond or GameStop, which we think it is, and you're getting your lunch eaten by online competitors, well-funded online competitors, and you're selling tchotchkes, and your only business is to exist to get your insiders out, okay? What if you traded at lower values there, and that's probably more accurate as to what's going to happen. At least that's what we think, okay? Okay, some considerations. They have a good management team. Refresh, remodel, relocate. The good management team sold their stock early. They're getting paid very well. I think the CEO made $7.5 million last year. It's got a 20% short interest. Could they lap same-store sales increase? Unlikely, particularly that Halloween was in the third quarter this year, fourth quarter last year. Cheap valuation, we've discussed it. But there's MIT laughing all the way to the bank, okay, because they pulled out $1.4 billion, 2.1 for the insiders. Can it be? So one of the things that they talk about is because it's such small stuff, right? It's an average ticket of $4 that Amazon won't, this can't be Amazon. It's being proven that unfortunately it can be. Framing and top sellers are online. The cost of capital and ROC, we would argue that you should look a little bit more closely. Lease trends, very interesting in any retailer, right? With the way that the real estate market has been so soft, and with this many stores, right? You would think that they would have the ability to crush their lease rates, right? When anything comes up for renewal, they'll say, we'll stay here, but we're going to do it at -5 or -10, right? Best Buy did that. Very smart. These guys, unfortunately, have said over the next 2 years, we expect 2% inflation in our lease agreements. It just so happens that the guy who negotiates their lease, if you look at the related party section of the 10K, happens to be owned by Blackstone, but that's just a coincidence that they're paying them $7 million a year. That's just a coincidence. So look, we don't think there's a private equity player that's going to take them out. Could be wrong. Seems unlikely. It's a cheap stock. But is it? So that's my presentation. I don't know how to put that back up.
Yeah. Questions?
I covered it all.
I know.
All right. David, do you want to fry me?
Yeah, what about Party City?
What about it?
It's a very similar story.
Very similar story, and the stock action has acted the same, right? Party City has $2.3 billion of debt on top of it. But this is a much larger market cap company, right? There's a lot more market cap to give here. And you've got a motivated seller, too, right? Blackstone and Bain, who continue to feed the market, right? Any spike up will be an opportunity for them to do an overnighter at the market. Yeah.
Oh.
So Keith, sort of following up on that, why Michael's just like, is the idea here just because Michael's cosmetically looks like something that should be cheap, should be so attractive that you're going to just whack it instead of, I mean, we just heard that the whole retail sector has maybe 3 months before it might drop again. I'm just curious why specifically Michael's here.
We think the setup is really good, and it has been really good. And at the end of the day, the only thing I can emphasize, which everyone I think in this room is really aware of, is your biggest risk is who's going to buy you out, right? I mean, that's your biggest risk. And if anything, these guys are bill themselves as the consolidator, okay? Even though every big chain, the debts are trading in the pennies, right? So I'm not suggesting that Party City isn't a great short, but there's not nearly as much market cap left there as there is here, okay? And when you start to capitalize the leases, they all look really ugly. They all look really ugly. And you know, the one thing that we love about the business, one thing we love about the business is every time the stock puts its head above 20, you know somebody's coming in, located 8 blocks that way, to sell a huge block of stock and knock it down again. And that's a nice comforting factor, I think, in a short. The other thing I forgot to mention, if I have another second, is that they bought a company 2 years ago in China to effectively insource all of their product. So they're moving up the chain in private label. Right now they're close to 70% private label, and they want to get to more. They were 30% when they were private, 35% when they were private. So the problem with that, as any good retail analyst will tell you, is that your margins can improve short term, like 2 or 3 years, because you control everything. But generally speaking, when everything in your store is private label, if you can't move it, it's your problem, right? You can't share the discount or the price cut or whatever with some other little supplier. It's your problem. And we think, as inventories have built up a little bit, this could be their problem, and it could be this quarter. So.
Yeah. By the way, one of my observations is, as I think about the shorts pitch today, You know, there are many different flavors of shorts, and I generally got drawn into the battleground shorts. You know, Herbalife, Tesla. You know, Chris over there loves these battlegrounds like Energos or Tilray. But my experience is that shorting melting ice cubes, they're not battlegrounds. There's no fraud. It's just dead man walking. It's container store, like that chart David put up. You know, over the last 5 years, it's Bed Bath & Beyond, just these melting ice cubes. You're not going to get destroyed. The thing's not going to double in your face against you. And even one stock out of 10 that does that and wipes out gains on the other 8, you know, or 9. So do you generally, is that generally like you just avoid the battleground stuff and just find melting ice cubes, or is this representative of the stuff you like to do?
Thank you. I think so. Look, we spend a lot of time getting very concentrated long in ideas that we like a lot. We rarely short ideas in our sectors. In our history, our 3 largest money makers have actually been stocks that we were short first. They broke. We covered, and then we went long. One was a activist situation, and 2 others where I would very proudly say were constructivist situations, where we were able to really work with management well.
Yeah. Yeah, my single biggest winner was shorting Netflix, getting destroyed. You at least are smart enough to profit on the way down. But actually the 2 biggest winners in my investing career were Netflix and General Growth Properties. Both stocks I was short. General Growth Properties from 40 to 1, and then flipped around and went long from 1 to 20 in the crisis after they filed for bankruptcy, and Bill Ackman came out with that presentation. That was such a gift. And then it was actually losing money shorting Netflix made me redo my work gain and appreciation for the business. And then I waited for the stock, covered the short, waited for the stock to collapse by 80%. And then it's been a 50 bagger since then. And I wish I had stuck around for the whole 50 bagger, but got 5 bags out of it anyway.
All we had to do was buy GGP and go home.
Yeah, exactly. So thank you.
Thank you. I'll be around. Thanks.
All right.
Thanks.
I hope you enjoyed this video. Again, if you'd like to learn more about Kase Learning and our programs, just go to kaselearning.com. And if you have any questions, email me at info@kaselearning.com. Thank you.